Hey, business owners, we know you know the importance of maximizing every dollar. With the Delta SkyMiles Reserve Business American Express card, you can make your expenses work just as hard as you. From afternoon coffee runs to stocking office supplies and even team dinners, you can earn miles on all your business expenses. Plus, you can earn 125,000 bonus miles for a limited time through October 29th. The Delta SkyMiles Reserve Business Card. If you travel, you know. Minimum spending requirements and terms apply. Offer ends October 29th, 2025.
Reality radio for a really great future. We're talking real money.
Well, for pretty much every Saturday, for eons, it feels like anyway, Tom and I have been hanging out here with you on the radio in Seattle on the station that is now known as Northwest News Radio. You know it by another name, but everybody still probably calls it the other name.
I think they do.
But it's not that other name, so
nope,
we're not going to call it that. But we're here, and we've been here for a long time to try to do one thing well. Get you to a better financial place in the future. Try to help you avoid getting ripped off, save better, spend better, invest better, and deal with money in a sane, simple fashion, because it really doesn't have to be as hard as it seems to be. So, to do that, we share information with you on every show. We also, though, want to take your questions that you can call us with on Saturdays. It's the only day of the week you can call us live. The number is 855-935-8255, which spells talk, T-A-L-K, talk with us. I'm Don. That's Tom in the Model Military Airplane Museum.
You forgot the modern part.
No, it's not modern.
Isn't it the modern military?
No, it's the Model Military Aircraft Museum.
Okay, that's disappointing.
Because they're dude. Do you see some of those planes? They're from like World War II.
Yeah,
those aren't modern.
Okay, to me they're modern.
Only
World War I. That would be ancient.
You're beyond an old soul. So call us, 855-935-TALK. We've got lines open for you right this very moment. Now, one of the things we do spend a lot of time on is the investing world. And over the past couple of decades, almost all of you have become investment obsessed with large U.S. growth stocks. You're just crazy about them. We look at portfolios all the time, and guess what we see a lot of? Large U.S. growth.
AKA the Standard & Poor's 500.
Exactly.
Yeah, pretty much, yeah.
So
makes up about 85% of the investable assets in the United States are in that.
Yeah, because it's been the hot place, because it's been. I said been.
Okay.
Been. I didn't say over what time frame.
That's a good point.
It has been over the last 2 decades.
I heard a very reputable podcast guy yesterday saying it's been the best place to invest recently.
No. See, recently is no. Over the past few years, it has not been the best place to invest.
AKA Don McDonald.
Yeah, no. You took it out of context. I'm talking long term.
You know me. I'm a journalist. I'm good at that kind of thing.
Yeah, lying to people. Yeah.
Might be a bit strong.
Yeah. Okay. Fake news.
Oh, there it is. Yeah. Okay.
Anyway,
so
now
let's talk about this.
See what he did?
Yeah, you were good.
He sort of
I hijacked your intro.
He
is what
totally
I did.
hijacked my introduction.
I did.
It's all right. I'm going to go away
the question,
now. You just
and
go.
This is from our friend Larry Swedroe, who we have massive.
One
respect
of our
for.
only friends.
Yeah. He and another friend of our, Paul Merriman's birthday today, by the way. So maybe we'll get to that later. But
just
quick
got
question.
To it.
Okay, good. That's enough for Paul. Okay, 5 seconds out of several hours. Quick question, says Larry. What has been the best performing asset class? An asset class is a group of stocks that have similar characteristics over the 5 years ending September 2025. Now, he points out, if you're like most investors, you probably answered U.S. large growth stocks. Mostly like the Standard & Poor's 500. Certainly has been the darling of the financial media coverage. However, you and most investors would be wrong.
Yeah. Okay, but come on. One, it's not by much.
Not 1.3% a year is,
and
when you
two,
add that up over time,
it's in a very aggressive, niche asset class.
That part is very true. Risky. I mean, these are companies outside the United States.
Yeah, it's outside of the United States.
Yep.
And they're tiny companies.
Yep.
And by the way, we're not looking at the actual index.
No, these are funds.
Yeah, so it doesn't really count as an asset class. It's a fund. It doesn't.
You could make that argument.
A fund is not an asset class. No, by no one's definition
and one is managed and one is not really managed. VOOG is the one that Larry refers to, the S&P 500 growth ETF. That's made 15.6% a year for the last 5 years. Compares to Dimensional's International Small Cap Value Fund, DISVX, DISVX, 16.9% annualized. And by the way, much of that comes from this year. Did you see these numbers for this year?
This year numbers are huge.
DISVX up 40% this year. But it just speaks volume as to why you need to be invested in these things all the time and not too much in these, because they have periods of time where they don't do very well. Past 3 decades, developed international markets have traded at an average of 31% discount relative to the U.S. This is another reason I try to get people to expose some of their money to international, because it feels like, and you're right, Don, it could look different in the future, but they feel underpriced compared to U.S. securities due to all the factors that people look at when you compare the value of stocks, right? They have not performed as well over the last, and you're correct, 15 years. But this is a very good point to make, because you need to be exposed to all these things all the time, not just now, all the time.
Right. And they need to be not the portfolio, but just a part of it. You want all of these asset classes, and that's why we say that exact same thing over and over again. 855-935-TALK is our number.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
And just to make sure that the comparisons are all fair, those numbers for the S&P 500 and for the Dimensional Fund were through June 30th.
What's said here through the end of September.
Because I just looked at June 30th and I got a 16 point.
And by the way, we need to be careful. It's not the S&P 500. It's the S&P 500 growth. I mean, so these are
that's right.
The growthier firms. VOOG. It's a little different than
that's right. It was VOOG.
VTIAX.
Yeah, we need to be,
Yeah, no, got to be honest. But the bottom line's still the bottom line. You've been rewarded for maintaining diversified portfolios. You have been this year for sure, and the last few years, right? At a time when people said just own the S&P 500, that's one. The other part is, and this is really hard for a lot of people because I get the calls from you. It's hard to stay in things when they don't work for a while, right? We've seen it over and over and over again. And diversification means you're going to hold assets that will disappoint you at times. That's a difficult thing, and you just got to get over it and think long term. That's
right.
it.
But see, the trick is, and you've got to train yourself to do this, to not look at the pieces and parts of your portfolio, to look at the whole darn thing.
Yeah.
Because when you look at the whole darn thing, the picture looks a lot better.
If you're trying to figure that out, call my wife. This is why she's still in the relationship. The big picture still looks good. The individual pieces, not so much.
855-935-TALK. I'm going to ignore that. 855-935-8255 is the phone number. And let's go out to Baltimore, Maryland. Gene, welcome to Talking Real Money.
Gene.
I know you guys are not lawyers.
No.
But at the same time, you deal with a fair amount of people who accumulate wealth. I'm one of those people. My wife and I have a house that's paid off. Our net worth, if you include everything, is about $8 million. We're both in our 70s. And my question is, everything we own, except IRAs, is jointly held.
Mm-hmm.
All the financial assets we have a spouse as first beneficiary, 2 children as second 50-50.
Okay.
So my question is, do I need a trust?
Well, it sounds like your estate. It sounds, if that is as simple as your estate is, that there is the spouse and then secondary beneficiaries, 2 kids. There is no charitable need. There is no argument over. You don't think there'll be any fights over anything. There are no tax issues. Well, yeah.
But back to, by the way, just to clarify that, in the great state of Washington, I think it's better to have property as community property rather than joint tenants. It's a small thing, but I believe the holding at Schwab is better one way than the other for taxation. But that's a whole other thing.
Oh, no. I don't know anything about that.
Yeah, anyway, because I think we went through this a few years ago. But here's the thing. No, Don's right. If everything just goes as you plan, sure. The trust, there's no reason to trust it. I have a trust. We've talked about this. I have a somewhat more complicated family structure than
yours
many.
is tougher than his. He's got just 2 kids.
So, I know. So, and if you know that's going to be right down the line, wife's going to take everything, or you're going to take everything if one party dies before the other, and then it's handed off to others, then you're probably okay. But here's the other situation, frankly, Gene, with $8 million, you can afford to go ask a professional, and that's exactly what I would do.
Yeah.
I hate to say it, and they may say, they may rub their hands together if they're not a good person.
Yeah, see, but here's the again, this is the problem. There are so many attorneys out there who will write a trust for everybody who walks through the door just because that's what they do and that's how they make their money.
Yeah, the trust mills.
They're trust mills. And again, it just doesn't, to me, it doesn't sound like, Gene, why would you go out and spend all the money on a lawyer when it appears there's no need?
I would at least get another opinion, I guess, would be my take. So
maybe
to add to the mix, my son is an attorney.
And what does he say?
I never even asked him.
I would ask him.
He's done a lot. He's in his late 40s. He's done lots of things. Yeah. He's never really. He's helped with divorces. He's done this. He's done that.
He's going to have a basic understanding, but
does he know the level of wealth that you have?
They should.
I don't think they have a clue.
Then
how much
and by the way,
we just know we're generous with them.
Yeah.
And money is not an issue with us. If we need a new car, we pay cash and walk home.
Yeah, but
which is wonderful. But
you're getting to the age where the kids need to be involved. Anyway.
Exactly. They should know. And I've tried to be pretty clear with mine. Look, if everything works out, here's the way it's going to go. But
I've been really clear with mine. If everything works out the way I planned, you're getting nothing.
They know where everything's going. They know everything.
No, but I would tell them.
They just don't know the dollar amounts.
Yeah, I think I would fill them in on that. That's a family thing. I get that. But I would start with him and ask him, here's about how much we have. Do we need to write a trust? It'd be a good starting point. You could probably get better independent advice, as Don said, than walking into somebody else's door and saying,
it's going to be more independent.
Yep. Oh, yeah, you need a trust. Sure you do.
Time to talk.
Okay.
Time to talk.
Thank you.
Thank you, sir. We appreciate it. 855-935-8255 is our phone number. We are not, and we never have claimed to be, attorneys. We really don't even like giving legal advice. It's like giving tax advice. It's so complicated. We try to give you the best information we can come up with that we are aware of, but there's so many twists and
by the way, when I look at all these cases, I'm never right on that. Looks so obvious it's going to work out this way. It always seems to work out the other way. So
wait, you're admitting you're never right?
Not on legal affairs, generally not. especially ones that have been personal to me. Every time I've said, this is where this is headed, it goes completely different. It never works out the way I thought. So
you're honest with yourself about that. You're honest.
Among other things.
You don't know.
Yeah, exactly.
855-935-TALK is our phone number, 855-935-8255. Again, for some reason, I think when the World Series is over, hopefully the Mariners make it.
Oh, please. Thank you, sir.
Then you'll get back to calling our show again. We'll be back, though, with more. Tom's got some questions if you don't call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Our phone number is 855-935-TALK, 855-935-8255. Earlier, Tom was talking about community property in Washington. Washington is just one of 9 states that has these wacky community property laws. Yeah. Every other state considers the property acquired during a marriage to be equally owned by both spouses. It's different in Washington, and here's why.
Well, because you get the difference really is in the taxes, right? The surviving spouse will get a step up in basis on the entire property.
Right. So
with joint, you only get it on half
the property. So if you own a house together and
correct.
It's appreciated over you paid $200 for it 30 years ago and it's worth $800 now, that $600,000 in capital gains, which of course is going to be lower, would just vanish. Thered be no tax on it. Is it to the state of Washington though? What? Yeah, that would be the state of Washington. What do the feds do with that?
I think that's federal then. Again, I hate getting all these tax things because it just gets so convoluted.
Wow. See, this is why we don't like tax.
Yeah. But I believe that is on.
Is it federal too? Okay.
Yeah, I believe it is. So anyway.
Oh, it respects other. Okay. The IRS.
This is why I like community property over joint tenants.
The IRS doesn't have any rules about it, but it respects the community property state's rules for tax purposes.
And don't call now. They won't be answering for a while. So
855-935-TALK is our phone number.
We'll answer.
Let's go to Maple Valley, Washington. Michael, welcome to the show.
Hello.
Hey, Michael.
Quick question. Can you all hear me?
Yep.
Yes, sir.
Yes?
Yes.
Okay, good. I'm getting ready to retire, and I wanted to get any updates or feedback on percentage of withdrawal. I've read 3%, 4%. What are your thoughts on that?
We're different.
We're generous. We're going to give you 10%.
Yeah,
How's
sure.
that?
Yeah. Take 12. Take 12.
Bless your hearts.
And we're just kind people. That's just who we are.
Actually, we believe very strongly in another way of doing it. That's not the 4% rule. We still think if you're going to go with that kind of a rule, an amount plus inflation, that 4% generally works. We've run Monte Carlos on it, and the failure rate is very low.
Yeah.
Very low.
But
we love flexible. We just we believe, we know from our lives that both of us, you can be a flexible spender. You can spend more one year and spend less the next, as long as you have a reasonable budget. So we love a flexible withdrawal.
Yeah, and we've done this at retire meets and at other classes we've held where we've shown you that a 5% flexible withdrawal, that is, for example, this year with a 60-40 portfolio up about 9%, you've had a good year, you'd be drawing out more because 5% of that total dollar amount would go up. But if it's 2022, well, that's bad news. You're going to, Wild Waves instead of Hawaii next year. So there's you have to live with the changes of that. Every person's different. And again, there is no one right or wrong.
Tom would just cut the food budget and go to Hawaii both years.
Probably true. I'll eat pineapple for the next 6 months.
We live on a budget. We've budgeted all our lives. We've always pay ourselves first. We've listened to your show for many, many years and have been to Retire Meet, loved it. Any literature that you can point me to that's maybe out on your site? Do you have anything that talks about this flexible?
Wow.
We must.
Good question.
It's been
wow. We certainly have talked about it on podcasts.
Oh my gosh, yeah, we've talked about it so many times.
And we've talked about it at Retire Meet where we've given, I think in the old days in Retire Meet, before we merged in with Appella, we used to give out the table where we showed you a 5% withdrawal strategy. It's just gotten so cumbersome now with the compliance folks that we just can't do that stuff anymore. It's just part of being in a bigger organization. But we certainly run those numbers for people all the time. So I'm trying to think where you would go get. I think Larry Swedroe's most recent book has the actual numbers in it, but I don't know that he does flexible. I don't know that he does flexible in it. But he actually shares those specifics.
Yeah, I'm looking.
It's a really good question, Michael.
Flexible. We planned to have the same spend rate when we retire as we do now, which is completely crazy talk. But that positions us so that if things get really bad, we can cut back real fast.
Oh, I think, by the way, most people, no offense, Michael, but I think most people should run the numbers on what you're spending today. The idea that you'll spend less in retirement, sometimes that works and sometimes it doesn't. So I'd take the number today.
You need to look at today's number. Thanks so much. I'll look for it. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
You know that one of the things Michael brought up with the withdrawal rate, that one of my favorite quotes of all time about that is from Christine Benz, who will be speaking at Retirement next March. You know what she said?
No.
The only correct withdrawal rate you'll know is after you're dead.
No, see, that's not true.
Okay,
she's wrong. She's
last
absolutely
check
wrong.
Right bounces, I guess you'll know.
That's what I was going to say. The 5% with flexible is brilliant. Because
it won't run out of money.
Because you can't run out of money.
You're taking out a percentage of whatever you have.
You cannot run out of money. That's the loveliest thing about it. It has basically 100% success rate, whereas the 4% rule has about a 95% success rate.
So it depends on what your goals are.
Right.
Do you want to leave money to others? Do you want the last check you write bounce? All those things. It's up to you.
But for papers, I did the lovely thing about commercial breaks is that you can go out and look for things.
Yeah. Okay.
All right.
Good.
So I found a 2006 paper from the Journal of Financial Planning called Decision Rules and Portfolio Management for Retirees.
And do they mention the 5% variable withdrawal?
5.6%.
Wow.
You
feel better, Michael. We granted him 10, so we're cutting him back.
Wade Pfau and Michael Kitsis did a paper in 2014 called The True Safe Withdrawal Rate.
Wow.
They put it at 5 to 6%. Vanguard did a study in 2020 entitled Sustainable Withdrawal Rates in Retirement. They found that the 5% variable rate had incredible success. And Morningstar did a paper in 2021 and then updated it in 2023 called Safe Withdrawal Rates. And again, they reaffirmed that 5% of your assets annually can sustain your portfolio indefinitely, and the numbers have historically worked out relatively well. The only period where there might have been some suffering, but the whole world was suffering, was between 1929 and 1932.
Yeah, we remember well, but the rest of you don't. So the thing about all of this is, again, to me, it depends on what kind of lifestyle you want to live, whether you want to leave money to others, right? Because that is a big decision to make, and how much variability you're willing to live with. And by the way, we give you the 5 and the 4, but doesn't Ramsey say you can take out 8 or something because you make 10% every year or something?
Yeah, because he believes if you invest with American funds, the average annual return is 12% per year.
Well, there you go. So if you're making 12, take it out.
Well, because
7,
that's
8,
what
no
American fund says.
That's right. So there you go.
It's not historically.
Live it up, man, is my take.
Anyway. 855-935-TALK is our phone number. We also take your questions at talkingrealmoney.com on that. There, a contact form, and those come into Tom all the time. He's got a big stack right there.
I do.
Take it from the stack. Take one from the pile.
Just a minute here. Okay, pulling that out. Yeah. Okay, this one comes from Franklin, Tennessee, which I think is favorite spot of yours.
Wait a minute. That's really close to where Dave Ramsey lives. That's like, right down
talk about coincidence, huh? Stephen writes, I understand that up to $90,000 of my capital gains can be deemed tax-free. Can you elaborate?
Only if your total modified
your
adjusted gross is below 94. Yes, then you would have no capital gain. But that includes the capital gain in that MAGI number.
That's the part people forget.
Yeah. Yeah.
So if you made, 20 grand and you've got 90,000 in gains, you're going to pay some capital gains tax.
Right.
Yeah.
But if
you can
had,
pay zero if you have no income
right,
up
if
to
you
$94,000.
had $30,000 in income and a $50,000 gain, you're going to have a zero rate on the $50,000 gain.
Yeah.
Right?
We haven't talked about our tax situation yet this year, have we?
I don't
You just
want
got your return done. I got my return
It was
done.
awful. I hate it. I hate doing tax.
How many pages was yours?
I don't know. I do it online. I can't tell, and I'm not printing it because I don't want to.
I didn't print mine either, but I could tell how many pages. You know how many pages my return
No, mine
was?
was filed electronically. It was all e-filed, so I didn't even see.
Still scan through
I
the
didn't even see
return.
PDFs and things.
Yeah,
No, I don't even have those.
You know how many pages?
Yours was a lot of pages.
Do you know why it's so ridiculous?
Because you make too much money.
Well, I guess you could. Wait, well, that's a value judgment, really.
I make too damn much money. He's going to Hawaii
211
again.
pages. 211 pages.
I'm not
really?
going to Hawaii this year. He's going to Hawaii again.
Why don't you come with?
Where else did you go?
Did
you go to Europe this year? I didn't go to Europe this year.
This is really good.
Did you go to Hawaii? Yeah. Oh, he's going to Hawaii again. Do you know where I'm going?
Anyway,
Do you know where I'm going next week? I'm driving up
You're
the
going to
street.
Disney
I'm
World.
driving up the street to Disney for a few nights.
You're a better person than I am. See, my carbon footprint's the size of a 747.
And I'll be taking the hybrid
to the point.
5 minutes to Disney.
There's very few people that are going to get zero for capital gains. That's what I was trying to get to. Very few, because you have to have basically no income.
Yeah, for all intents
pretty
and
low.
purposes.
So there you go.
All right, let's go to Seattle. Chris,
Okay.
welcome to the show.
I'm working from home, Chris, so don't feel bad.
Chris?
Hey, I have a question about target date retirement funds. And like in my work 401k, I use those, and they're easy. And I have like rollover IRAs from previous jobs that I definitely fall into the hodge-podge-itis category. And I'm thinking, can I get sufficient diversification, in your opinion, by just going with target date retirement funds for that money?
Sufficient, yes. Optimal,
How much money are we talking?
Not necessarily, but it doesn't matter the amount. You can still get sufficient diversification with target date funds. You're just going to be missing some asset classes that we like overweighting.
We just mentioned at the beginning of the program, international small cap value, emerging markets.
But they're
so little of that in target date funds.
But as he said, he's got a bad case of hodge-podge-itis, and he's trying to
clean that up.
Clean that mess up.
Yeah,
so
clean that mess up. But here's what I would do if it was me and our friend Paul Merriman, whose birthday is today, as I mentioned earlier. You can see Don's thrilled with that. I would do 80% in the target date fund, as Paul's recommended, and 20% in a small cap value fund. That's been done.
A small cap value international, or
No,
just small cap, U.S. small cap.
Really,
Just
and then
US small.
because you're getting international exposure in the target date. We hope not as much as we'd like, but that's a very simple portfolio that gets rid of the hodge-podge-itis and still overweights you slightly towards small and value, which we think is likely to be beneficial. At least it has been in the past. Thank you so much for the call, Chris. We'll be right back.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Because it's really important, real money. That stuff you use all the time to pay the bills, travel to Europe and Hawaii, all of those important things. 855-935-TALK is our phone number. 855
Slings and arrows. Keep them coming, man.
8255.
I'm ready.
You sure?
Deflecting them.
Sure. All right.
Absolutely. I've been a high school soccer referee for 35 years. I've taken bigger woundings than you can supply here, for sure.
I've been a talk show host for 40 years.
Good point. We're both taking the beatings.
Man.
All you can do is go look at our Apple comments if you want to see that. So,
hey, most of them are good.
Most of them are good.
But
we do have a lot of people that hate us.
I know, but
it's okay.
I'm okay. Yeah. They can hate me.
Me too. Yeah.
I can still love the haters.
Bring the hate. Sure.
Bring the questions, since nobody's calling in with them at 855-935-TALK. Dip back into your bag of question tricks there.
I got them.
All
I
right.
got them
I
from
knew you
Lebanon.
would.
Got a writer from Lebanon today.
Lebanon, Pennsylvania?
No, New Hampshire. Thomas.
Okay.
Thomas. Hi, Don and Tom. I enjoy Talking Real Money podcast on my daily walks. You both talk a lot about the importance of a financial plan.
Boy, do we ever.
Yeah, boy, that's one thing we are really obnoxious about. Yeah,
we are. I'm curious, he says, what financial planning software does Appella Wealth use to build financial plans for their clients?
I have no idea.
You wouldn't know that, would you?
I would not know that because I don't get involved in that day-to-day.
And now you got to be nice to me or I'm not going to tell you.
I don't. It's not for me. It's for the caller. It's the listener. So, if you don't want to. If you don't want to, I got a call. I'm just going to go to that. The heck with you.
Okay, real quick. We use eMoney. We've used Money Guide Pro. We've used a lot of other.
Money.
And remember, I don't work in this space all the time. I have people. So, but from what I can talk to the other advisors and other people in the industry, eMoney really is the best. Right now, these things change, right? But Money Guide Pro, very good. eMoney, a little bit better.
Well, according to eMoney, more than 100,000 financial professionals choose them.
There you go.
For the software. So
our folks really like it, and it seems to work pretty well. So
now we have a phone call. See, just like that. This is like, I think we've beaten last week now, which wasn't hard to do. Huh?
Yeah. We've beaten it by 2.
Now. Let's go to Seattle again. Sam, welcome to Talking Real Money.
How are you? Thank you very much. Hey, Mike, I think I have an easy one. What small cap value ETF do you recommend?
Go ahead.
Well, we have several we like, but if I had to pick one, and yes, we own it, and we get nothing for owning it, would be AVUV. That is the Avantis U.S. Small Cap Value Fund. It's relatively inexpensive for the asset class. It charges about 0.25%. It's pretty diversified. It uses the academic principles that we believe in that suggest small and value companies make more than large growth ones over time. And it's been a good performer. Not that says anything about the future, but so AVUV would be a very good fund. Dimensional has a very good fund, of course. We talked about another one last week. I can't remember. Oh, it was the iShares small cap fund, but that was limited diversification.
That was just the 600. The thing we like about Avantis small cap value is the way they tilt towards small in value. They go a lot more small than just an index would, which gets you more of that aggressiveness that we're looking for when you're talking about this asset class as a small part of a portfolio. We're never suggesting this should be the whole portfolio. It's too aggressive. But as a small part of a really well-designed portfolio, having that smaller small that it's hard to get elsewhere should and has, we don't believe that's necessarily always going to happen, but it has done pretty well by them.
And I think you can go back and look at the AVUV versus, for example, VBR, Vanguard Small Cap Value Fund. Which is just the index. Yeah, which is just the index, and it has outperformed the index for it's only been around for 5 or 6 years, I think, or something. But so it's done a little bit better for the reasons Don mentioned, but you're probably going to have to live with greater volatility, right? Because it is a little more focused on those areas.
Actually, it's done not just a little better. Again, these are not indicative of anything in the future, okay? But the total return for AVUV over the past 5 years has been 17.5 versus 14 for the index.
Total return or annualized
Total return annualized. No, average annualized return.
Wow. That's crazy. 3% a year better.
Wow. 3 points higher.
Yeah, again, and that says nothing about the future, but it's the way the fund is operated that we favor that one over the Vanguard Index Fund.
And the Vanguard ticker was what, please?
V is in victory. V is in victory. B is in boy. R as in.
You forgot, haven't you?
All right.
I did. I used to have that nice table.
Rabbit.
One of our clients sent to me. Rabbit. Sorry. There's a
Romeo. It's actually Romeo.
Romeo. Thank you. That's good. Yeah.
I just like
great question.
All right.
Yeah.
Thank you.
You're welcome.
It's a great question.
Thank you very much.
Thank you.
Our pleasure.
Yeah, AVUV, shockingly good return.
Wow. 17 a year. Wow. That's it's been amazing. So, but again, you don't know what that could mean to the future. It could underperform because the index may do better. We don't know that.
Right.
But for all the aforementioned reasons over 1,800 podcasts, we like it a little better.
There are reasons why it should outperform. Yeah. And again, it's really simple. See, everybody tries to make it sound complicated. The studies and the data. No, it's so simple. You know why they have the potential for more return?
They're
greater risk.
Yeah, I could have. They own
small and more value.
Exactly. riskier companies.
Oh,
smaller
that's even
and
better
riskier.
than value where you're.
Yeah, crummy companies.
Yeah, they have more.
Remember what a
crummy
value company
companies.
what truly value company is the composite of all of its assets are more than what the market says. That's
and
what
one
a
of the
value
things I
company
do
is.
also like about the Avantis fund is that they have like almost 800 stocks in that portfolio, which for small cap value is quite a decent.
I wonder what
chunk.
dimensionals have. I think we looked at it. It's something similar. I believe.
855-935-TALK. We got a couple minutes left. Thanks for being there. Thanks for listening.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
We started the show, the last hour, last podcast, yesterday's podcast, talking about the big drop in Bitcoin.
Yeah.
I just found
crypto in general, by the way.
Yeah, I just found this article by Mark Hulbert from
I saw the same one.
Yeah. He basically says that the crypto guys are tying themselves in knots trying to explain away the drop that he says, quote, was bigger than the 1929 market crash by saying it was just a temporary thing. As he says, one, crashes happen. They always happen. They always will happen. Two, a crash means that there's some reason that the price got ahead of itself and that people are taking profits. So you can try to explain this away, but the risks were too high for the market. And these kinds of things happen. You can't say it was an aberration because maybe it wasn't.
Yeah, and I think the other lesson to be learned here is, again, if this had been stocks or bonds, you would have heard a lot more about this. It feels like it's been buried to me in some ways, and that always makes me suspicious as well.
Could it be, though, because it's really only about but we almost have a trillionaire, so it's just a trillion-plus asset class. It's not a multiple trillion-dollar asset class like equities. Could that be the reason?
Could be, but it got a lot of press when it was going up. A lot.
That's because there's a vested interest in singing its praises by the people who own it or have a vested interest in ETFs or trading it. They have a huge reason to hype it, and they also have a huge reason, as Hulbert says in this piece, to poo-poo any decline.
Sure.
To make light of the decline, but the decline was substantive, and who knows what the future brings. I think I've always thought, even though you guys claim it has great utility, I've yet to see that, but maybe. But the reality is, I just think it is way too speculative and dangerous.
Yeah, and Mark Hulbert's a guy I think you should trust. He used to write a great newsletter. He's written about markets for 40 year long time.
Writes for the Wall Street Journal and Market Watch. He's well respected, and basically he says this is a risky asset class.
Yeah, I think that's true.
I don't even think it's an asset class, but it's whatever it is. It's a risky thingy.
Yeah, it is a risky thing.
I'm using the scientific term, thingy.
That's very
thank you.
big of you to do that. Thank you.
Let's see. We're running out of hour. We really appreciate you being there. Do you have anything you want to add for our lovely listeners?
Because we also mentioned this hour that that diversification is it's you hear it, but I don't see it a lot. I look at a lot of portfolios and people are still too U.S. centric, too U.S. large centric. They don't have enough other asset classes in it, as you mentioned. So, one of the things we've done for, longer, if you consider the previous firm we were affiliated with, we, for free, we'll take your portfolio, we'll look at it, we'll tell you how diversified you are, how much you're paying, how much risk you're taking.
Yeah, but you're going to try and sell me something.
Yeah, well, sure. Okay, but we haven't done that.
You're going to try and sell me an
time.
indexed annuity, aren't you?
we let's not even go to that story, which we should have mentioned, by the way. But so the short answer is, yeah, we do that for free. We've done it for a long time. TalkingRealMoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.
You know the words dominating today's headlines.
Private equity,
generative capital gains tax,
America's
tip fueled by market volatility, on Fed rate cuts.
But do you understand how they impact your world and your wallet? In a world that skims the what, understand the why. Because context changes everything. Subscribe at Bloomberg.com.